Welcome to TMS Insights for the June edition. Jeremy Hook and Ben Clark bringing you this update. So it is the end of the financial year almost, and we've certainly been busy here at TMS. We've been going through all the numbers to make sure all the super side of things has been accounted for in terms of contributions, pension payments, etc. We said that last time, and if you have any questions about that, please do give us a call, Ben. But coming into the end of financial year, generally speaking, a little bit of selling on the small cap side of things.
Yep.
As tax loss selling is realised.
Yep, absolutely. And, you know, of course, we saw some big statements out of the Federal Reserve night before last, which was, you know, I think a fairly significant event in the markets. And the main thing that came out of that was that the tapering of quantitative easing is going to continue. So they're now only going to be printing $35 billion a month. It sounds funny to say only before
big numbers,
that, but
really,
still a lot less than they were 6 months ago. But I think the main change in rhetoric from Janet Yellen was that she has dampened down the expectation for where rates will be in the longer term, i.e. rates won't be as high as the Fed sort of led the market to believe. And what that's seen, of course, is another sort of push of money into anything that's decent yielding, and another pickup in the Australian dollar, which is one of the best yielding sort of currencies in the world.
Well, that's it, and they're more comfortable with higher inflation. And the reality is that you've got negative real interest rates in the US, roughly about 1.8%. Australia and New Zealand having hiked rates only last week, have got positive real interest rates, so are getting some of the world's capital flows coming down here right at the moment.
And this follows on from, I think the ECB also gave some big decisions since our last video update, and principally the main one there was that they have moved to negative interest rates for banks putting cash on deposit with the central bank, which is just, you know, an unprecedented sort of move. We saw very briefly during the GFC in the US rates went negative, but not for, I think it was for 3 or 4 nights or so.
And the whole purpose here is to avoid deflation, so they're encouraging price activity and price growth so they can get growth in the general economy. So overall, that's going to have implications for us here in the immediate term. It's currency related. It's also yield related. So we've seen that 10-year bond go down to 3.66% locally, and that's obviously driven up yielding stocks. But one of the big news stories this week was Woodside Petroleum, and that was a truly mega deal in terms of the Australian market, the exit of Shell, the tax effective way that it's been structured, and going forward, Woodside looks like a slightly different company. Yeah,
well, I mean, it's solved a number of problems, hasn't it? I mean, we know that Shell still had a 23% stake in Woodside, which is a huge sort of dollar stake, and it really, you know, it dampened the share price because there was always this view at some stage they would start to sell that stake out again after hitting the market with it a couple of years ago. They found, I think, you know, to Woodside's management credit, rather than going out and purchasing, you know, going into Leviathan or going and purchasing a big producing gas field, doing something a bit more exciting and sexy, they've decided to purchase half of the stake back from Shell, and that will be EPS accretive, dividend accretive, etc. And the rest of the other half has, of course, been sold down to the broader market, which has led to some selling in the market, and has also seen a bit of pressure on the Woodside share price.
Which is possibly just short term, but again, the market is a little divided on it because Woodside turned its back on Leviathan, as Ben mentioned, the Israeli project, which offered a fair amount of growth for them. And to some, they're seen as a relatively low growth company. To us, so one of the things we really like is any company that puts its shareholders first. And I think here we've got a shareholder accretive deal, so value adding deal, and a management team that's not prepared to do deals at any cost. And I think we go looking for companies that do that. We know that, and the clients will know that we like Sol Pattinson and the Wesfarmers Group as a result. Michael Chaney, as the Woodside chairman, has infiltrated the thinking at Woodside with the Wesfarmers shareholder value mantra, which I think is a great thing. Now, the other big area of news has been the retail sector. So we saw a number of downgrades in the last couple of weeks, principally on the back of a softer economic outlook post the budget and a weaker consumer. So Super Cheap Auto, they've been given 3 downgrades.
3 profit downgrades this year.
Reject Shop, 2. We had Noni B,
Pacific
Brands, and other retailers coming down in fear, but Flight Centre got caught up a little bit in that.
Yeah.
And JB Hi-Fi.
Yep.
and yet those two are good stories.
Yeah, because I think we've done quite a bit of work on Flight Centre, and we've got a bit of a note there if clients do have some interest. So I think that the retailers were sort of blaming two things: the warmer weather and the budget.
Yeah.
And you do sort of wonder sometimes, are these really just excuses because the business isn't going as well as should be? But I think Flight Centre, sort of came out and they said, look, we have had a weaker May, but historically we do, because it's when Easter and Anzac Day fall and people are away and they're not booking holidays.
Yeah.
And we're still on track for what is a record full year.
It really wasn't a profit warning, was it?
No, it was more to say we'll probably be at the lower end of guidance and the higher end.
Yeah.
And it's interesting because the share price has fallen about $10 from its high it set in February after a very strong result.
Yes.
The company's got a lot of cash on balance sheet, pays a good dividend.
Good dividend, yeah.
And we think it'll achieve reasonable growth in the longer term. So
very good company and very investable.
And JB Hi-Fi.
Well, again, everybody was thinking that's the next candidate in the retail space to downgrade. I'm not sure whether it's because people were out buying flat screens for the World Cup soccer, but they're not. Their guidance now is 8 to 10% increase on last year in terms of net profit, which is a fantastic outcome. It's a terrific stock, high dividend yield. It's got a great balance sheet, and it has, of course, too, a very good return on equity. So JB Hi-Fi, very good news yesterday when it gave its profit outlook. So again, these are companies now that have taken the risk away somewhat because they've told us exactly where they're at.
Yep.
We're not really going to have to guess and wait till August when they do report.
Exactly. And not worry about some bad news might hit between now and then.
Yeah.
The retail space, I think we both agree, is a very hard space to invest because I would see them more generally as trading stocks where when everyone's very downbeat, they can be excellent buys.
Agreed.
And 6 months ago, everyone loved the retailers, and we've seen most retailers fallen 40-30% since then. So now's the time, I guess, to get interested in them when everyone else is really beating them up.
Yeah, they're typically stocks not to buy and hold for 10 years, but you can be more in and out, unlike some other shares. Well, that's all we've got time for today. Thanks for joining us on this last edition for the financial year. It's been a good one, and we wish you a good time until our next edition in July.